Hey guys, I have the Apple chart up here and I wanted to just kind of take a look at options and the idea that if you're buying an option, it's a vertical bet, and if you're selling an option, it's a horizontal bet. So I just have Apple up here because I was looking at their chart. I haven't looked at it in a while, and they're gonna have their earnings coming out soon. But just to look at Apple, it's so they were doing really well up to the bubble, and the dead cat got them pretty good. And they didn't crash quite as far as the general stock market, and they bounced pretty well. So it's roughly the general chart as most of the other kind of companies. But this is one of the companies that's kind of supporting the XLK. Microsoft and Apple have good balance sheets and pretty good charts, it looks like, and they're still going to turn over when this thing turns over. So this is Brian Lewis with MMT Investing, and things just changed. And this is not investment advice, but for example, if Apple were to make a down move here, the best type of option for that sort of move would be to buy a put option. And that's because a put option is a vertical move. So when you're buying an option, you want it to move vertically. So it will go forward in time, but you want it to go down vertically forward in time. And if you're selling the option, that's a horizontal bet. So if you're selling the put, then you want it to just go sideways. If it goes sideways until expiration, then you make the money and the other person loses the money. So it's basically an insurance policy where the person selling the option wants it to go sideways. So for a put, if you buy a put and it goes all the way sideways until expiration, then that put expires without being able to claim the insurance policy. So the person that sold the insurance policy makes the insurance policy money, basically. And if it goes down, then the person is going to have to pay that insurance policy. So that's the idea, that buying an option is a vertical bet and selling that option is the horizontal bet where you're providing the insurance. And so if you buy open put on AAPL on Apple here with a time length wide enough to get down to the bottom of this thing, then once you get down here, it's going to be worth a lot of money because you can cash in the insurance policy. And then the same thing in the other direction. Say if Apple was going to go up in this direction, you would want to buy a call. And it would be the opposite here, where the person selling the call would want it to go sideways or down. So if it ends up sideways or on this side of the line, they get the insurance money. And if it goes up, then they would have to pay that insurance policy. So that's the idea of vertical and sideways moves, and why, when we're in this incredibly vertical, volatile market, why buying puts or calls is a really, really good strategy, and selling them is super, super dangerous because sideways movements are rare here and vertical movements are happening all the time. Although we have had a bit of sideways consolidation here in the last couple weeks, so maybe, but it still is pretty choppy and volatile. So in these type of environments, you want to make vertical bets, which is buying a put or buying a call. And then also we're in a long-term bear market. We're in a credit contraction down cycle in a long-term bear market. So the overall trend is down and the cyclical trend right now is also down. So it's just, we're looking for just down, 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 down. So buying a call up against all of that gravity is dangerous. So what I'm doing is, on the down moves, I'm trying to buy puts to get a multiple kind of, you can make more money with puts because you're controlling a bunch of shares. But then that's dangerous on the way up. So say that it reverses up here, whereas I would want to have a large percentage of my bets down be puts. On the way up, I'd want a really tiny percentage of my positions to be calls, because you don't want to get caught holding a call if you're in a bear market in a down cycle, because you'll never get back there and you'll just lose it. So that's a general look at vertical buying of options and the horizontal selling of options out to the expiration date. And then again, when you're trading these options contracts, you almost never get to the expiration date. Usually you get down into the money and then you just sell that option contract to someone else. Or occasionally, if it's just going out to expiration, then it's just kind of worthless and you just let it expire. So that is the general idea. And the more specific idea, I guess, is if you do actually get all the way out to expiration here and say you're in the money, then this would be buying a put out to the expiration date. Then you have to exercise the option, like your broker will exercise it, and you actually trade the shares. And that's a little bit more complicated because they want you to actually have the money in your account, and or they'll have to like loan you the money to do the trade, and they don't like it. So they want you to have that money on margin to actually do the trade if you're going to exercise it. So that is a little bit more complicated, but you never have to exercise it. Even if you're on the last day, you can just sell it on the last day, sell the option to someone else, and you never have to exercise. So that is vertical and horizontal options, not investment advice. Please hit the YouTube button. Please hit the like button to help me out with the YouTube algorithm. And happy trading.